Hi, and welcome back to the Business Career College video series. In this video, we're going to look at private health services plans, PHSPs. It's not a term that you run into much in practice. What you'll more often see in practice is the health spending account or healthcare spending account. And these are essentially just practical ways of implementing a PHSP or sometimes you'll see a cost plus arrangement. So these are all various arrangements that use the PHSP rules or healthcare spending account. Now, the PHSP rules are actually designed originally to take care of this situation where we have an employer. So this is the rules in their base form. The employer pays premiums for a health insurance plan for an employee, and then the employee uses those benefits tax-free. So it's a tax-free benefit. Both the premium and the actual reimbursement of expenses are tax-free to the employee, and this makes this a very attractive benefit, and it's why we see this so often, not just the appeal of it from a practical perspective, but the tax appeal is also fantastic with this because it lets the employer deduct these premiums while passing on a benefit to the employee that is not taxable either when the premium is paid or when the benefit is received. Now, that's not really what we want to focus on here. We want to focus on these other variations on this, the healthcare spending account, health spending account, or cost plus arrangement. So what we see here is a variety of concepts, but they're all going to look roughly similar in the sense that now instead of using a health insurance plan, the employer is going to set aside, and we'll use an ER for employer and EE for employee from here on. The employer sets aside or budgets for a certain amount of claims. And then the employee can draw on that budget. And the rule here would basically hold that it would have to be something that fits into the medical expense tax credit. We do have another video that covers the medical expense tax credit. And as long as we meet all of these criteria, METC there is medical expense tax credit, as long as we meet all of these criteria, then we have the same treatment where the employer gets to deduct this and the employee has this as a tax-free benefit. So in a health spending account, we're typically going to see the employer say, we're going to set aside $500 or $1,000 or $2,000 or whatever it is. In a healthcare spending account, the same type of arrangement. Cost plus is essentially an after-the-fact arrangement where the employer says, oh, you have a cost of $500. We're going to now cover that off, plus a little bit of an administrative cost that an insurer normally assesses there. So this can work out very well, but we get ourselves into some problems here, especially in smaller businesses. So in a big business, in a big incorporated business, this is not going to be much of a problem. We basically will see all of this done on an arm's length arrangement. And as soon as it's arm's length, then it's very unlikely that you have what might be considered an unreasonable benefit. Essentially, we say, you know what, if you're making $300,000 a year, maybe a $30,000 health spending account is not unreasonable. That might be what it requires to retain that particular employee. So what we can do here is we say, all right, now I'm self-employed. So can a self-employed person use the health spending account. They can, however, there are some restrictions here. So a self-employed person, they could go out and buy a plan of insurance, but if they're going to use one of these other arrangements, this health spending account or cost plus arrangement, then the limit here is $1,500 per adult in this self-employed person's household and $750 per child. And it's not that the limits are ascribed to those particular people, so it's not that you can have $1,500 of claims for that adult, but rather what this would mean in a household with, let's say, 2 adults and 2 minor children, your total limit for what you could do this year would be 1,500 times 2 here and 750 times 2 here. So we would have $3,000 for the adults plus another $1,500 for the children. So in total, this self-employed person could have up to $4,500 of costs associated with a health spending account or a cost plus arrangement, and it could be for any of that group of people. Now, this gets a little bit more complicated when we are incorporated. So it's easy enough when we're dealing with an arm's length party, but it gets more complicated when we have a smaller business and we're dealing with the shareholder now. So we're going to look at 2 different types of scenarios. In our first scenario, we're going to have a shareholder who has employees. So can this shareholder use a health spending account for themselves? And they can, but we have reasonableness limits here. So the reasonableness limits say you can use this, but only to the extent that you would have used this for an employee in the same position. So if you're paying yourself an exorbitant amount of benefits here, that's where we end up with a problem. And a good example of this is a case called Spicy Sports v. the Queen, in which an owner of a small ski shop in Whistler, British Columbia, tried to run $43,000 of medical expenses through the Cost Plus plan, and it was seen to be far in excess of what he would have allowed an employee in the same position to do. So when we violate this reasonableness, and the problem here is reasonableness is a question of fact. It's not something where we can firmly establish what's reasonable in each circumstance based on some formula. Instead, we have to say, hey, if you were an employer hiring this person and you're paying them X number of dollars of salary, what would be an appropriate amount of health benefit to also offer that person? And that's where we would arrive at a reasonableness test. So this reasonableness issue then, what's going to happen here is we say, okay, what would you have offered to an employee? And if you exceed that, then we end up with a shareholder benefit, which means it's not deductible to the corporation and taxable to the shareholder as regular income. So we want to be very cautious of that. And that's where, as with any of these issues, we want to make sure we're getting good advice from a tax accountant or a tax professional who understands the taxation of this. Now, what if you're incorporated and you have no employees? Well, this is where we have a little bit of a problem. There is actually a technical interpretation from Canada Revenue Agency. If you want the technical interpretation number, it's Technical Interpretation 2014 05213 01. E5. And it says, no, you can't. Now, it does qualify that a little bit and say that there may be circumstances under which you can, but the surface here, the surface level says that if you're incorporated with no employees, that you cannot use a cost plus or a health spending account type of arrangement. Now, I'm aware that this is quite common in practice and that CRA hasn't been in the habit of challenging this, but I would be very cautious before implementing this in an incorporated business with no employees. So CRA's position is no, this is not allowed, but as stated, there are definitely some qualifying factors there, and one of the things that CRA technical interpretation says is if you can show that another business in the same capacity would offer this benefit to an employee, then maybe it's okay to do this. So unfortunately, as with so much of the Income Tax Act, we have a huge amount of gray area here. If I were doing this myself, I would want to watch and see first off that we're not doing this only for tax reasons. I would say, you know what, would we do this if we had employees? And I might apply the reasonableness test over here based on the $1,500 and $750 that we see. I'm not suggesting that as tax advice. I'm saying if I were doing that myself. Certainly every position is different and you do have to be very cautious of this. So I would not implement one of these in a incorporated business with no employees other than the shareholder unless you get very good tax advice and you're fully aware of the risks of doing this. So I hope that helps to understand the private health services plans arrangements, and I hope that you see how to use these in your practice and that you enjoy your continued studies. Thank you very much.